Hello, everyone. This is Lindsay Shuck with Family Office Network. Thank you for joining our FON webinar series for today. We have BDO with us to navigate us through some ideas to help us through the pandemic. Marty Cass is going to go ahead and get us started. Marty, over to you.
Thank you very much, Lindsay. BDO's private client service practice is really happy to be putting this program together with the Family Office Network. Our private client service practice is a boutique practice that helps affluent families navigate the wealth management landscape. We integrate strategic advice, finance and administration, and the governance process. We create an independent environment to steward family values and wealth from generation to generation. Our family office leaders have experience leading some of the wealthiest families in the world. Today, we are at a really unique time. With the health challenges of COVID-19 comes significant income, gift, and wealth transfer tax opportunities. Today, we have a great panel. Our goal is to have a creative conversation with you concerning some of these opportunities. During the program, please submit questions. We will make our best effort to answer them. If we don't have time to get your question, please send one of us an email, and we'll be real happy to respond to it after the program. Our panel consists of Jack Knuckles, who is the National Technical Leader of BDO's Private Client Service Practice. He has more than 30 years of professional experience serving high net worth individuals, executives, closely held business owners, trusts, and estates with respect to income, estate, gift, and generation skipping tax planning. He's got an LLM from Georgetown University in taxation and a JD from Tulsa University. Lori Myers has more than 20 years of public accounting tax experience, concentrating her practice exclusively on closely held businesses and their owners, high net worth individuals, complex multi-generational families, trust and estate planning, and private and operating foundations. She is the managing principal of BDO South Florida offices of the private client services and the co-leader of the Southeast region for the firm. She's got a JD from Nova University. Tracy Pumo is a partner in our national tax practice. She provides a unique multidisciplinary approach to ensure clients achieve their family's wealth, tax, and personal financial planning goals. Tracy's clients include family offices, multinational families, executives, closely held business entrepreneurs. She advises clients regarding cross-border estate and gift planning, as well as the sale of closely held business interests and wealth transfer planning. She's got an LLM and JD from the University of Florida. In our current environment, we experience large business losses. We have great uncertainty as to the income tax policy in the future, and the tax code and the CARES Act provides various income tax incentives. So there are really significant opportunities that high income taxpayers should be thinking of to save income tax. Section 165I is a tax provision that allows taxpayers to accelerate certain losses from a federally declared disaster. Jack, how can people benefit from it in the current environment?
Hey, Marty, thanks for that question. I know we're off to a great start because you're already quoting Internal Revenue Code sections. Code section 165 little I of the Internal Revenue Code is what you referenced. And that is a unique provision within the tax law that is designed to help out individual and business taxpayers where they have incurred a disaster loss. And for those of us that live in the areas of the country where you experience hurricanes, tornadoes, floods, out in California, the fires, sadly, you may have had experience with this code section in the past. Marty, like you just discussed with the COVID-19, it's a little different than the typical disaster that we experience due to Mother Nature. This particular code section, I might say, Marty, is somewhat magical in what it can do, in that if you do have a loss that is attributable to a disaster, this particular section allows you to take the loss. In this case, it would be a 2020 loss for this year, and make an election to treat it as if that loss was incurred not in 2020, but in 2019. So I think for purposes of this call, Marty, we can't get into depth with respect to how this particular code section applies because of the virus, though, or as President Trump calls it, the invisible enemy. It's a little different in terms of the virus isn't running around like a hurricane and knocking down physical structures. So the challenge may be determining whether your particular loss is attributable to the national disaster that the president has declared. But nevertheless, as we discussed, Marty, in prepping for today's presentation, if this is applicable to you, and I would encourage the participants on this call to consult with their legal counsel and their CPAs to determine if it is, then the so-called magic, I call it the magic of this section, is it causes that loss to be able to be deducted in 2019. So for those taxpayers who have not filed their 2019 return yet, if this could possibly be applicable to them, they could receive a refund that they hadn't anticipated because of this loss, or if you've already filed, you could file an amended return and make the election to carry it back to 2019, resulting either in a reduction of your tax liability for 2019 and likely a refund, Marty. So
Jack,
a wonderful
give us
code
an
section.
example
Yes.
or two. Jack, give us an example or two of what this may apply to.
We were discussing that, and like I said, it's a little more difficult. I know that there are some CPAs out there that have been arguing that its application could be quite broad. I think what you're looking for are situations where there's been damage to perhaps property because of the shelter-in-place order, where you could not gain access to your property, and as a result of that, the property such as produce or food or whatever is no longer viable. One could argue that those losses are directly attributable. But we're going to get into some code sections, Marty, where that may not matter because of these other provisions that were enacted in the CARE Act, and you could still carry those back. But nevertheless, I think it's unique, and I think you got to look at each taxpayer situation to determine if you. I think the challenge is going to be to determine whether your loss is attributable to this disaster.
All right. So if I had an inventory loss, if I had inventory, a product, and due to the nature of due to the COVID-19, I wasn't able to sell it. It became worthless. Then I might be able to take something like that back to the prior year. Or if I made payments on seminars or meetings or whatever, which in the next year got canceled and I lost my money, things like that, I would be able to take back. And it's somewhat broader than that, so you certainly should talk to your advisors about it. Section 461 is another section, and that section limits individuals in the use of net business losses to offset other sources of income. Tracy, how did the CARES Act change this provision, and what opportunities are created by it?
Yeah, so let's just step back for a moment. When we had tax reform passed at the end of 2017, the Tax Cuts and Jobs Act held that beginning in 18, net business losses in excess of $500,000 for joint filers or $250,000 for all other taxpayers were not allowed as a current deduction against other income. And then these threshold amounts were supposed to be indexed for inflation, and in 2020 were scheduled to be $518,000 for joint filers and $259,000 for all other taxpayers. Any disallowed business losses were to become a net operating loss applied to subsequent taxable years and carried forward. The CARES Act suspended the application of this excess business loss rule for 2020, and interestingly, retroactively suspended it for 2018 and 2019. So this means that taxpayers in 2020 are going to be allowed to offset their business losses against other income. But the retroactive removal of the limitation for 18 and 19 is not elective. So taxpayers who already filed 18 and 19 returns and applied the excess business loss limitations are actually going to be forced to amend their prior year returns if they want to take advantage of the losses that were generated. On the bright side, amending the prior year returns actually probably result in a refund opportunity for a lot of taxpayers.
All right, thanks. Jack, the CARES Act also made some technical corrections, and the big one is the bonus depreciation allowed on qualified improvement property. Explain that change and the opportunities that are created by it.
Yeah, back to, again, we're going back in history to the tax reform changes that occurred at the end of 2017. And one of the provisions very beneficial to taxpayers, as you know, Marty, one of the things that you can deduct on an income tax return is the depreciation expense. And depreciation expense is unique because you don't have to spend cash necessarily in order to get that deduction. It is just one of those things that we allow in our tax code to reduce our overall taxable income by depreciating an asset over time. What happened in the Tax Reform Act, in order to incentivize taxpayers to go out and acquire property and or to improve property, was the ability, if you met the requirements of the statute, to completely deduct the entire cost. So 100% depreciation deduction in the initial year of acquisition. And that's not really depreciation, Marty, that's a deductible expense. Unfortunately, and this often happens when you have huge tax legislation, is that there are mistakes. And in this particular case, there was a horrible mistake in the way the statute was drafted, so that the provision, which was intended to be beneficial, did not benefit qualified improvement property. And that type property typically you will see in the restaurant businesses and the retail businesses, and where they could have been able to deduct the costs of their improvements within their property, and because of the mistake by Congress and the way the statute was drafted, they were stuck with a 39-year write-off. So what the CARES Act does is it goes back and it fixes the mistake. So now, much like Tracy just mentioned with the excess business loss, this was fixed back to the 2018-2019 year. So now for those that are in the restaurant and the retail business, and what businesses have been the recipient, other than perhaps hospitality, of the impact of this national disaster with COVID-19. So it's a wonderful opportunity for those retailers and restaurant businesses to go back, and others that this applies to, and fix and deduct those properties which were placed in business within the time frame. So those are things, again, which I think you need to be aware of this. You should be chatting with your CPA about whether going back and taking these write-offs in the appropriate years is appropriate and makes sense given your personal situation. But often, much like the change to the excess business loss that Tracy mentioned, is that this will result in possible refunds to the taxpayer, and therefore an excellent opportunity in these times of need, especially for the retail and restaurant businesses.
Yeah, Jack, and this is pretty broad. It covers really any commercial type of property, not residential property, or any business, and it covers anything that's not a major structural addition to the building. So, for instance, even a roof. They put a new roof on a building, that could qualify. And one of the interesting things about this is you could go back, let's say in 2018, you couldn't take it. You could go back and change it in 2018 and take the loss there, or there's a way of like that you could do it and take that additional depreciation in your 2019 return, whichever works better. So there's a lot of flexibility with it. So I mean, it's a big thing because it's 100% write-off, as you said. So Lori, with these provisions that Jack and Tracy are talking about, they create losses that we could take in either 2019 or 2018, in addition to the business losses that are being generated. How does the CARES Act changes to the net operating loss provisions help us with regard to these and other losses?
Thanks, Marty. Well, I just wanted to make sure too that these losses that we're talking about at the entity level, before you can even take them through to the individual level, obviously the individuals need to have basis, at risk basis as well, and potentially could be passive. So even though we are talking about all these losses at the individual level, you know, when you have those issues before we can take the losses. But assuming we get to the loss deduction, then the CARES Act did provide some changes, because previously NOL deductions were generated in 2018 were limited to 80% of your taxable income, and any remaining was required to be carried forward. You couldn't carry it back. But changes to the CARE Act now permit individuals with NOLs generated in years 18 through 2020 to carry the NOLs back 5 taxable years. Any excess will still be carried forward indefinitely. So the CARES Act also eliminated the 80% taxable income limitation as well for years 2018 through 2020. Additionally, which is interesting, as Jack was saying, that it was in order to provide taxpayers with a quick refund claim process and to put money back in people's bank accounts more quickly, the IRS did pass in April a favorable guidance related to the quick refund claims for Forms 1045 and for individuals and Form 1139 for corporations. So this guidance extended the deadline for carrying back the NOL that arose in the year 2018 historically would have had to been filed by 12/31 of that year. And now they've extended the period to file your quick refund claim for 6 months. So you can now carry your NOL incurred in tax year 2018. By June 30th, you can claim that and carry it back. If you can't file it by June 30th, then you will have to file the Form 1040X to carry your NOL back and slow down the refund process. And also, in order to expedite the refund process on the Form 1045, they are actually providing, IRS has provided a fax number to provide a quicker way to get the refund claims processed.
Marty, we've had some questions about this that have come up in the practice, and as a practical matter, COVID-19 is impacting some of what Lori just described, because think about it, if you've got to go back to your 2018 return, and now, thanks to perhaps Tracy's point, which is now you've freed up those excess business losses, whereas they were limited before, now they're opened up. So you'd go back and you'd amend your 2018 return, which may very well generate a net operating loss for the 2018 year. And what Lori's describing is then you could fax that 1045 form into the government to expedite the process of getting the refund for the 2018 year. The problem is you need to amend your 2018 year return. So you need to file an amended 2018 return, and guess what? The government is basically shut down right now. So you can fax the 1045, but you would also have to attach a copy of that amended return. And until they've actually processed the 2018 amended return, they won't be able to get you your refund. So the virus is even impacting the ability to what's clearly in the law, but the functionality. I know I was on with the AICPA and the government yesterday, and there's just all kinds of practical issues where when the government's not there to answer the phone or review the mail, everything's getting backed up, Marty. So we can sit here and talk about carrying back these losses, and I know those who are really in need, they'd love to be able to get those refunds, but sadly, the virus, because it shut down the IRS, it has slowed down that process and the ability to gain access to those refunds, Marty.
Thanks. One thing, putting together these NOLs and the ability to go back to change depreciation 18 or 19, or even going forward from a tax planning point of view, if you're looking to minimize taxes, the bonus depreciation is really very helpful. And one of the things you can do is get what they call a cost segregation study, which will break down the assets you either are acquiring or the parts of real estate into the components, so you could get a large bonus depreciation by reducing the depreciable life of the property and making them qualify for bonus depreciation. So that's and BDO does cost seg studies. So if anyone needs any help with that, you could contact us. Tracy, they changed the required minimum distribution rules for taxpayers. How did they do that, and what's the effect?
Yeah, so now that you've amended all your prior year returns and gotten a nice refund, and you don't need the cash, you can go ahead and waive your required minimum distribution for 2020 for certain defined contribution plans and IRAs. This applies even for taxpayers who turned 70 and a half in 2019, but deferred their first RMD to April 1 of 2020. So RMDs that were taken after February 1, that might have been taken before the CARES Act provided this relief, can be rolled over, provided they're rolled over before July 15th of 2020. The CARES Act initially provided for a 60-day rollover period, and then that was expanded slightly by the issuance of an IRS notice, which extended the 60-day rollover until July 15th. So if you've taken the RMD in January, right now, no relief for you to roll that over, which is, I guess, a little bit of a bummer, but hopefully we'll see some additional guidance or relief for that. Other notable changes to RMDs happened not only in the CARES Act, but in December of 2019, the Secure Act was passed, which also affected RMDs and increased the required minimum distribution age from 70 and a half to 72 for those individuals who attained 70 and a half after December 31st of 2019. So, and then the Secure Act also ended stretch distributions from IRAs and qualified plans. The stretch distribution had permitted retirement plan assets to be distributed over the lifetime of a child or grandchild beneficiary, for instance, after the death of the plan participant. The Secure Act required non-spouse beneficiaries to take the complete distribution by the end of the 10th calendar year following the account owner's death, with a few exceptions. The waiver of the RMD for 2020 doesn't impact this 10-year rule because the 10 years, it didn't start until death in 2020, and therefore your first year was in 2021. So we've gotten that question a lot. So you still have to take that distribution before the end of the 10th year. And similarly, the old 5-year rule, if you're familiar with that, when you have a plan that had no designated beneficiary, I believe you still have to take the entire plan balance before the end of the 5th anniversary of the participant. However, in the 5-year rule for beneficiaries who died between 2015 and 2019, the 5-year period is computed as if 2020 didn't exist. So you might get a little bit of leeway there in the 5-year rule.
Yeah, that's a lot, Marty. I guess the question I would have for Tracy, and I know this came up in another conference call. I think the government gives you this break because they did this back in 2008, 2009, because the required minimum distribution is based on your end of the year balance. So we would all be looking at much higher retirement plan balances at the end of 19, and you would be computing your required minimum distribution based on that higher sum. Nevertheless, I guess back to the group, why would it be appropriate to go ahead and take your required minimum distribution in 2020, even though you're not required to do so? Would that makes sense in some cases.
I mean, I think that's going to be subject to the individual needs of the taxpayer that you're considering and what their cash flow requirements are, you know, and the broader picture. I think there will be instances
Right,
where it might make sense for clients to continue to take the
because
RMD.
yeah, 2020 may be a lost year for a number of taxpayers. So your ability to take that distribution, Marty, and pay no tax on it, or pay it at a lower tax bracket, might be, and that's part of why I call it an upside down year. 2020 is an upside down year, quite likely for a number of clients and taxpayers, simply because we're always thinking of inflation and income, and this year, because of the disaster, we're going to be looking at reduced income and perhaps even losses.
And I think because of that, Jack, I think it'd be a great time, to add the Roth conversions in there as well, because now that you don't have to take your RMD, you could use that money to convert to your IRA to Roth without having to first satisfy the RMD amount. So you could use that money that you're going to basically pay tax on anyways, take the low values in your IRAs. We don't obviously know when the lowest value is, but it may be a good time to take your low value out of your regular IRA and convert to Roth. And especially since, like Tracy said, you no longer have your stretch planning, so it may be a good idea to try to get as much out of your regular IRAs and get them into your Roth as much as possible.
Let's switch over to some wealth transfer issues and opportunities. Today, with the gift and estate tax exclusions high, there's significant potential for tax changes. There's a decline in most asset classes and privately held companies and investments, and our interest rates are very low. So that there's a lot of opportunities in the estate planning area. We have grant to retained annuity trusts, which we call GRATs. We have intrafamily loans. We have sales to defective trusts. With our panel, and we can start with Jack. Let's talk about these three different vehicles and what the advantages and disadvantages are, how they work, how we could use them today and with today's environment.
Sure, Marty, I'm happy to chat about that. It's starting tomorrow, May 1st, May Day. We will be seeing the lowest interest rate set by the government that I've ever seen during my career, and I've been practicing since 1980. And they're even lower than the period after the Great Recession from 08-09. Starting tomorrow, the so-called 75-20 rate, which is one of the rates we use in doing the calculations for one of the techniques you mentioned, Marty, is 0.8%. So in the first time in my career, the 75-20 rate has actually dropped below 1%. And we'll talk about why that's significant. Also, the government every month sets interest rates that are used for various purposes. One of those purposes is interfamily loans. And Marty, the interfamily loan rate for a 3-year or less loan is 0.25%. 0.25%, 3 years or less. A midterm loan runs from 3 to 9 years. That interest rate is 0.58%. And the long-term rate over 9 years is 1.15%, Marty. And that's amazing. And the wealth transfer that we can accomplish because of those insanely low interest rates is quite startling. You mentioned the grantor retained annuity trust. This is an irrevocable trust that clients can set up. The bottom line is every single participant that's on this phone call that has goals and objectives of moving net worth to the next generation, to your children, every one of you should have a grantor retained annuity trust up and running if you have not accomplished your goals and objectives of moving net worth to that next generation. And here's why. Each one of us who are U.S. citizens or domiciliaries of the United States of America have $11.58 million of exemption we can use to make gifts to next generation. So certainly you should be talking with your estate planning advisors to do so. But this technique, Marty, can use virtually no exemption. So even if you've used up all your exemption, you can make transfers to this irrevocable trust. And what you're doing is transferring the income and the appreciation on the assets in the trust to the next generation, to the extent that that income and that appreciation exceeds 0.8%. 0.8%. So I would certainly hope we're going to come out from underneath COVID-19 and we could set up these trusts in a way that the people that participate on this phone call are quite capable of having an internal rate of return on whatever project or asset that they're investing in. And Marty, it's going to exceed 0.8%. And to the extent that it exceeds 0.8%, you will be transferring that incremental increase to the next generation, totally gift tax and exemption free to the next generation. What happens if you don't beat the 0.8%? All the assets end up coming back to the client, the grantor. And so there really, quite frankly, is no downside. And that's why I urge every one of you that have a goal and objective of shifting net worth to the subsequent generation, that the grantor retained annuity trust is a wonderful technique to accomplish that. And quite frankly, there's almost no limit, Marty, as to the amount of property you could put into this, because if you put 100 million in it, you're going to get 100 million back to your client, but the income and appreciation on that 100 million above 0.8% goes to the next generation. And I know, Tracy, you had some examples that you had prepared for this.
Yep. So comparing a straightforward 7-year GRAT to a rolling 2-year GRAT strategy. So as Jack mentioned, 75/20 rate is 0.8%. We've assumed a 5% growth of the assets annually. So you can see putting 5 million into a GRAT at the end of 7 years, the remainder going to your beneficiaries is just over $1 million that you've gotten out of your estate gift tax free. And you can do even better than that if you do a rolling 2-year GRAT strategy. At the end of 7 years, you've gotten 1.6 million out of the estate to your beneficiaries. And if Jack didn't talk about it, but if you want to do even better than that, you can consider a sale to an intentionally defective grantor trust, because here we're not tied to the 75/20 rate. Instead, we get to use the AFR rate. And as Jack mentioned, the midterm AFR rate in May is 0.58%. And so if you do a sale to an I-digit, you seed the trust with 500,000 and then a $5 million note, you'll get just under 1.8 million out to your beneficiaries at the end of 7 years. So I mean, you know, the GRATs and the sales to intentionally defective trusts are the two most common strategies we see in transferring wealth.
How about they call it slats? I mean, slats are often used in a situation, and Tracy, maybe you'll explain it, where a person wants to give money to the next generation, but wants to have some access to that money during their lifetime, and they don't want to totally give it away, if you want to say it that way. How does that work, and how generally do you structure it? And that might be a good way to use your exemption up before the exemption disappears. And you might also explain the clawback provision, how that really, what the IRS came out with, which is really super significant, so that if you do make a gift now, they're not going to claw back and change it if they reduce the exemption. That's a couple of things to talk about.
Yeah, hopefully I can remember all of them. I think when you first asked about slats, Typically when you're doing planning with slats, they're reciprocal, non-reciprocal trusts, where a spouse will create a trust for the benefit of their spouse and the children, and the other spouse will create a trust for the benefit of the first spouse and the kids as well. So, the grantor of each trust indirectly has access to the assets of the trust via their spouse and kids. And so, this is a very popular planning idea because you're not really giving anything away. You still have that indirect access and control to it. We saw this pop up in 2010 as a very popular planning technique.
Yeah, and the clawback.
Okay, the clawback. So our exemption was doubled in the Tax Cuts and Jobs Act. So we went from 5 million to 10 million indexed for inflation. So we're currently at $11.58 million estate exemption, and that's scheduled to go back down, be halved again to the 5 million with inflation in 2026, assuming nothing happens with the election in the interim. And so there was concern among practitioners that there might be a clawback, so that if somebody had given away more than the 5 million, that there would be a clawback in a subsequent estate or gift tax due, or a gift tax due with the estate return later on. The government since issued guidance that there's going to be no clawback, so that really hasn't become an issue now, although it has gotten us to think a little bit more creatively when we're deciding whether or not to split gifts on 709s or not. And so, typically right now we'd want to use one spouse's entire 11.58 exemption before we look at using the other spouse's exemptions, just so that we're preserving that, so-called enhanced exemption between the 5 million and the 11 million that we've got currently.
How about gifts of partnership interest with the valuations you have today and with the ability to discount? How is that a good way in the current environment to make some gifts?
Yeah.
Lori,
so
anybody?
Yeah, I think Lori might have gotten kicked off. I'm not sure. On the valuation discounts, obviously asset values have declined quite a bit as a result of the current crisis, and so it's a great opportunity to transfer wealth, as we've been discussing with the slats and the grats and the sales to intentionally defective grantor trust. And the same holds true for family partnership interests. You can leverage the lower values to transfer more partnership units out of the grantor's estate with potentially greater upside.
Yeah, and Marty, whether it's a family partnership or whether it's a family closely held business, which we have a lot of those clients with our practice. Now, given what's gone on, many of those companies have been severely impacted, and therefore by necessity and the uncertainty concerning what will happen as a result of this disaster, it's going to cause, as Tracy was saying, an adjustment by the appraisers as to the value of the property. And then you combine that, if you're making a gift of a minority interest in a closely held business, you should be able to get some significant valuation discounts. And so for those that have objectives of shifting the family business in terms of net worth to the next generation, it's counterintuitive. Again, I call it an upside down year, but this is an awesome year to do it because you've got those very low valuations. And another thing, Marty, that you had pointed out, not on so far, but when we prepped for this, was, golly gee, what's going to happen in November? And the election will occur, and we may have a change in administration. And I know the Democrats certainly would like to make adjustments to some of these wealth transfer tax strategies that we just discussed, and they would also like to increase the rate of the gift and estate tax. So in light of that, many clients were talking about engaging in this type of planning anyway, and with the COVID-19 disaster, it's even a greater opportunity for individuals to engage in this type of planning. You're always looking for assets that have a low value to shift to subsequent generations so that wealth appreciation accrues at that other generation level, as opposed to in the client's level to be subject to an estate tax rate currently at 40%, but in my career I've seen it as high as a marginal tax bracket of 60%. So those I think are the concerns. And I'll be honest, I mean, it's kind of morbid, Marty, but the truth is, while this virus is out there and we don't have a vaccine, if your wills and trusts are not up to date, forget all this tax stuff. You need to really seriously sit down with your estate planning lawyer and get your affairs in order to be a good steward towards your family, because something could happen. And you know, it's uncomfortable to discuss that, but it's very real. And so this aspect of estate planning is, in this environment, given the low interest rates, the low values, and the risk of death, quite frankly, this should be addressed.
Thanks, Jack. Hi, everyone. This is Lindsay with Family Office Networks jumping in here. I just wanted to remind you that there is that chat option that you can utilize if you had any questions at the time for any of our panelists. We do only have about a little less than 10 minutes left, so I just wanted to make sure you guys all had the opportunity to jump in and ask questions.
All right, great. So if someone has a question, please interrupt us and we're happy to answer it.
I think Marty, I think Jack brings up a great point. You know, with the election, we don't know what's going to happen, but not only with the election, but with the stimulus plan, I think there's a high probability, no matter what happens with the election, we're going to see an increase in income tax rates next year, because either we're going to have to pay for the stimulus, or Biden's already released some of his tax plan where he wants to increase the highest marginal tax back up to 39.6%. He wants to restore the piece limitation and further limit itemized deductions. And he wants to tax capital gains at ordinary income rates if taxpayers' income's over $1 million, which is really a big one for our clients. I mean, that's going to hit them hard.
Should they be looking to sell some items to some capital, generate capital gains this year, and maybe generate capital losses to offset it, or generate capital losses this year and then reinvest in different types of stocks so that they have a carryover going into the future to offset income in the future, because you may have a much higher capital gains tax and other ideas like that?
Yeah, I mean, I think the easy answer is it depends, because every taxpayer situation is going to be different. But, you know, our usual advice is to defer income, you know, as long as possible, the recognition of income. And I'm not so sure that in what Jack calls this upside down year, that's really what we want to do this year. I mean, in some cases, it might make sense to recognize the income and take advantage of the capital losses that are generating right now, or the business losses that are occurring, and use those losses to offset income this year in 2020.
Yeah, we have a situation. Go ahead.
I'm sorry, I wanted to go ahead and read a question as we only have about 5 more minutes left. Lori has a question. Is a grant used only for cash giving, or can it also be used for stock giving?
Well, a grant can be used for stock giving, and actually a grant is more powerful if you're even given a family partnership interest, or you're given a partial interest in real estate, because the illustrations that were made was putting in cash. But if you could put in property that has a discount, I put in property worth $5 million, I get a 30% discount. So I'm really, I have a lower amount, so I have to take out less of a annual payment to myself, and more will pass on. So using property is better than cash.
Yeah, and Marty, I think the question, because we talk in terms of an annuity, and everybody thinks of an annuity like an annuity from an insurance company, which is a payment of cash. This annuity payment, and quite frankly, even the payments on the sell to defective trust where we are paying back an installment note, those payments can be made with property. So it doesn't have to be the payback of the annuity to the client or the payment on the promissory note if you sold it to a grantor trust. You can use property to make the payment. The only issue there is you have to value that property so that you meet the the annuity that's required on the grantor retained annuity trust, or if it's the installment note, typically you're paying interest only. Yeah, most definitely, most often we see property, not cash, as the transfer to these two vehicles.
We're going to be coming to an end soon. If we don't have another question, I'm going to talk a little bit about cancellation of debt income, because a lot of times you may be involved with a business that has forgiveness of debt. And there's a big difference between whether or not it's a corporation, a partnership, or an individual that where the debt is being canceled. And a lot of times there's significant planning that could be done, so you certainly should check with your tax attorneys and accountants in order to do that. For instance, in a corporation, the forgiveness is determined at the corporate level, and the individual shareholder won't necessarily be involved, whereas in a partnership, you test it at the partners level, so that it's a lot more risky for the partner. So that's, I think, a very important thing for you to look at. We have a cutoff at 150, so we're going to have to cut off pretty soon.
Thank you, Marty.
There's a lot more we could have covered, and there's a lot of ideas, and there's a lot of issues that you could face. And we're going to be sending out our emails. Please send us an email if there's any question that we didn't answer today. There's a lot going on with the payroll protection plan, which we wanted to cover, but we don't have time to cover, with some of these loans that are out there, as well as all these tax credits that are available, which are really significant. So that if you have any questions, don't hesitate to contact us, to call us, to email us, and we're very happy to answer it.
Here, this is Lindsay with Family Office Networks. As Marty said, we will be following up with everyone that was able to attend this webinar today. So if there are any additional questions, we promise they will get answered. Please reach out to us directly as well if you need anything in the meantime. And thank you so much for joining us today, and I look forward to seeing you in the future.
All righty. Well, we thank everyone for participating very much.
Thanks, Marty. Thanks, everyone. Have a great day.
Bye-bye.